We are witnessing something quite remarkable in India's credit landscape right now. For years, large corporates heavily relied on bank loans to fund their growth, working capital, and project finance needs. But the latest numbers from the first and second quarters of 2025 paint a very different picture. Corporate loan growth is slowing sharply. At first glance, you might think companies are borrowing less. But that is not really the case. What is happening is a strategic shift. Companies are increasingly choosing to raise funds from capital markets instead of knocking on the doors of banks. Let me give you some context. As per the latest data published, HDFC Bank's corporate loan book grew by just 1.7% year-on-year in the second quarter. That is a dramatic fall from the 18.8% growth it recorded during the same quarter last year. ICICI Bank also saw a dip, reporting just 7.5% corporate loan growth. Even public sector banks like Union Bank are seeing similar patterns. But this does not mean corporate India is shying away from borrowing. It just means they have found more efficient ways to do it. Here is what is really driving the shift. After the Reserve Bank of India began easing interest rates earlier this year, yields in the capital markets started looking far more attractive, especially for large, highly rated firms. These companies can now raise funds through bonds and commercial paper at lower rates and with more flexible terms than banks typically offer. And let us be honest, if you're running a cash-rich, investment-grade company, why would you take a bank loan at 9% when you can tap the bond market at 7.5%? It is not just about cost either. Capital markets offer more control. You get to choose your tenor, structure your repayment schedule, and diversify your investor base. For many treasury heads, it is like trading in a regular taxi for a self-driven luxury car. You go where you want, how you want, and often faster. Of course, this is not great news for banks. Corporate lending has traditionally been a major revenue stream for them, especially private sector banks. Now, with that flow shrinking, they are being forced to rethink strategy. Many are doubling down on retail loans, fee-based income, and transaction services. Some are also trying to offer structured finance solutions or co-lending partnerships to stay relevant in the corporate space. From a macroeconomic standpoint, this trend is actually quite healthy. A deeper and more liquid bond market reduces systemic pressure on the banking system and provides companies with broader financing tools. But it does call for better risk management, improved credit evaluation, and stronger market depth. As more borrowing shifts away from regulated banks, investor scrutiny will have to do more of the heavy lifting. This is not a corporate credit slowdown. It is a corporate credit migration. Corporates are signaling that when the capital markets are deep enough, flexible enough, and efficient enough, they will gladly bypass the banking system. This transition is not just about interest rates. It reflects increasing market maturity, stronger balance sheets, and greater investor appetite for corporate debt. Interestingly, this could also mark a turning point in how Indian firms think about their capital stack. With market-based funding becoming more accessible, companies may begin optimizing their debt structure more dynamically. That means raising short-term funds through commercial paper, locking long-term rates through bonds, and even exploring structured credit as an alternative to traditional loans. At the same time, this shift exposes a dual challenge. Banks must innovate their corporate lending approach, and regulators will need to ensure the capital market infrastructure keeps pace with the growing reliance companies are placing on it. Market stability, investor protection, and credit transparency will all become more critical in the quarters ahead. We will be watching how this transition unfolds, whether it remains a large cap phenomenon or filters down to mid-sized companies as well. Either way, the traditional monopoly of bank credit is breaking and a more market-driven credit ecosystem is taking shape. If you found this perspective valuable, please like the video and subscribe to the channel. We unpack financial shifts like this every week with clarity, context, and zero noise. Thanks for watching.